Private credit is the biggest loser when AI corrects. Speakers: Ashwath Damodaran, NYU Stern School of Business, and Joseph Scorn, host. Source: Fixed Plus Floating, The Credit Podcast, Episode 15. Date: recorded June 15, 2026. The arithmetic ceiling on the AI story. Ashwath Damodaran begins with a boundary problem that most AI market forecasts ignore. Global publicly listed companies generated roughly $142 trillion in revenue last year, while total employee costs across those same companies came to somewhere between $20 and $25 trillion. That relationship sets a hard ceiling on the entire idea that artificial intelligence will simply replace human labor. Even in the most extreme scenario, where every worker on the planet is automated away, the total prize available to AI companies is bounded by the global wage bill, not by whatever total addressable market figure appears in an investor pitch deck. When a slide claims a $20 to $30 trillion annual AI revenue opportunity, that is not an aggressive forecast. It is a number that cannot exist in aggregate, because it would require AI to capture more value than the entire cost of the labor it is supposedly replacing. This is the essence of what Damodaran calls the big market delusion. Each individual AI company can construct an internally consistent story about winning its share of the market. But when every company's story is added together, the implied combined revenue exceeds anything the global economy could plausibly generate. Equity investors can tolerate that contradiction for a while, because a diversified portfolio only needs a handful of genuine winners to offset the losers that never pan out. Credit investors do not have that luxury. A lender collects a fixed, capped coupon on every loan and absorbs a complete loss whenever a borrower's story breaks. That asymmetry is why a market-wide overreach that would simply be an awkward equity correction turns into something far more dangerous once it is financed with borrowed money instead of retained earnings. How the build-out shifted from equity to debt. The funding structure behind the AI data center build-out has changed markedly over the past 2 years. On the numbers discussed, somewhere between $500 and $600 billion of spending since 2023 was funded largely out of hyperscaler retained earnings. That marginal dollar has since shifted toward debt, asset-backed securities, and off-balance sheet joint ventures. Morgan Stanley's own projections point to roughly $250 to $300 billion of hyperscaler-related debt issuance in 2026 alone. In other words, the AI boom that began as a story funded by cash-rich technology companies is increasingly being funded by other people's money. Damodaran's concern is that this shift changes who bears the loss if the story does not play out. During the dot-com bubble, the build-out was funded almost entirely by equity. When that bubble burst, shareholders lost a large share of their capital, which was painful, but the damage stayed largely contained to those who chose to hold the stock. The AI build-out is different because a meaningful share of the capital behind it is debt, and increasingly debt sourced from private credit rather than traditional banks. If the AI growth story falters and companies run into trouble, that pain shows up as distress and default, and unlike an equity write-down, default risk does not stay neatly contained. It spills over into counterparties, employees, and the broader financial system. CoreWeave and the mispriced capital structure. CoreWeave serves as the clearest live example of what happens when equity narratives set the terms for corporate debt. The company's unsecured risk trades at roughly 500 basis points in the credit default swap market, which is consistent with a speculative-grade borrower carrying volatile cash flows and heavy capital spending. At the same time, its asset-backed infrastructure financing includes an $8.5 billion delayed draw term loan rated in the A3 range, alongside a $3 billion, $100 million syndicated facility backed by graphics processing units and customer contracts, priced on investment-grade terms. As the equity trades higher and the order backlog narrative improves, the entire capital structure tightens in sympathy. From a lender's perspective, that pattern runs backwards. The unsecured and structurally subordinated pieces of the balance sheet are being compensated like single B credit risk, while the so-called infrastructure debt is priced as though it were a mature, regulated asset with stable demand, when in reality it is a highly leveraged bet on early-stage AI workloads and a still unproven set of counterparties. Damodaran's assessment is direct. When a lender's spread is being set by market capitalization and narrative momentum, rather than by current cash generation and tangible collateral, that lender has lost the discipline that lending is supposed to enforce. He goes further in describing the broader private credit market's appetite for this kind of lending, asking pointedly who these lenders think they are, and arguing that the assumption that private credit investors must be sophisticated is mistaken, since in his view many are simply following the herd rather than pricing risk independently. The structural issue compounds within a single borrower. The most valuable, most liquid assets tend to be pledged to the most senior tranches of debt, leaving unsecured and holding company creditors effectively lending against whatever residual value remains in a technology stack with a short useful life and no guaranteed resale market. If the underlying growth story breaks, the losses will not land on the investment-grade labeled paper that financed the physical hardware. They will land on the parts of the structure priced as though they sat one notch below core infrastructure risk, when they are in fact dependent entirely on the equity story holding up. Why financing should act its age. Damodaran's corporate lifecycle framework offers a useful discipline for thinking about when debt makes sense at all, and the AI build-out is violating it in both directions at once. His rule of thumb is that a company's balance sheet should act its age. Startups and young growth companies derive almost all of their value from an uncertain future, so they should be financed with equity, or at most with convertible instruments, since straight debt introduces a hard default trigger into what should be an option on growth. Mature companies with stable cash flows and taxable income are the ones that should carry debt, because they can actually use the tax shield it provides. Declining companies, meanwhile, should be shrinking their debt in step with their shrinking asset base. If the dollar amount of debt stays flat while the business contracts, default stops being a remote tail risk and becomes simply a matter of time. The AI build-out breaks this rule from both ends. Cash-rich, mature hyperscale companies are levering up to fund what is fundamentally a young growth story, including exposure to off-balance sheet joint ventures that are structurally more fragile than their core businesses. At the same time, young AI companies whose entire value proposition is unproven potential are taking on straight venture debt to avoid diluting existing shareholders. On this point, Damodaran is blunt, describing venture debt as a practice that violates nearly every principle of sound corporate finance, since it puts an entire growth option at risk in order to save a few percentage points on the cost of funding. From a lending standpoint, financing a business whose value sits almost entirely in a wide, uncertain outcome distribution is effectively selling volatility. A lender who is not compensated for that risk through equity participation, tight covenants, hard security, or real operational control is simply mispricing the position. In that setting, a convertible instrument is the more honest structure, since it keeps the cash drag low for the borrower while giving the lender upside exposure in the same direction they are already exposed to on the downside. Overcapacity, leverage, and the trap of no return. A separate but related danger is what happens when excess capacity is combined with heavy leverage. Damodaran draws a distinction between good and bad overcapacity. In a young, still growing market, building ahead of demand can discourage new competitors from entering and can improve long-run economics for whoever is left standing. In a shrinking or structurally challenged market, the same behavior becomes a trap, since nobody wants to buy the very capacity a company needs to offload. His illustrative case is a manufacturing plant built to serve 5% annual growth in a market that is actually shrinking by 5% a year. The AI data center build-out sits uneasily between these two poles. The prevailing narrative treats today's overcapacity as strategic positioning, with hyperscalers and specialist operators building ahead of workloads on the assumption that utilization will eventually catch up. The complication is that the financing behind this build-out does not resemble patient growth equity. It resembles term loans, asset-backed securities, and long-dated leases with hard, fixed payment obligations. When an industry is oversupplied but mostly funded by equity, it can consolidate in an orderly way. Shareholders absorb the losses, unneeded assets get written down or scrapped, and the companies that remain eventually earn better returns. Once heavy leverage enters the picture, that orderly process breaks down, because no single operator can afford to be the first to shut down capacity and crystallize a loss while its debt still requires interest payments. Covenants and security packages are typically designed to protect existing lenders, not to enable the economically rational outcome of shrinking supply. The practical implication for anyone extending credit into this environment is that mean reversion is the wrong default assumption. The more realistic expectation is persistently weak returns, capital spending that continues simply to stay competitive, and a meaningfully higher chance that any eventual reckoning arrives through default rather than through a tidy round of mergers and consolidation. Rethinking distress. Default risk belongs in the cash flows. On the subject of valuing distressed companies, Damodaran offers one insight worth adopting directly and one worth treating with more caution. The insight worth adopting is that default risk belongs in the cash flows themselves, not buried inside an inflated discount rate. In his framework, a company is valued as a going concern using a cost of capital that reflects ordinary business risk, with a separate, explicit estimate made for what the company would be worth in liquidation and the probability of actually ending up there. Overall equity value becomes a survival-weighted combination of the going concern value and the distress value, multiplied by the odds of each outcome. For most equity holders, the distress component of that equation is effectively zero, because limited liability means shareholders cannot lose more than they put in. Translated into the language of credit risk, this is simply a rigorous version of probability of default multiplied by loss given default. An explicit survival scenario and an explicit failure scenario modeled separately, rather than an arbitrary premium tacked onto a discount rate until the resulting valuation feels comfortable. Done properly, this means genuinely modeling what happens inside a default, which assets can actually be sold, what haircut a forced sale would require, and how the remaining value is likely to be distributed among employees, governments, and senior secured creditors, rather than papering over those questions with a single adjusted number. Where the option analogy breaks down. The point that deserves more skepticism is how far to extend the classic options-based view of credit risk. In a heavily leveraged company, equity does behave something like a call option on the value of the firm, with a strike price equal to the face value of outstanding debt, while debt behaves like a risk-free bond minus a put option on the company's assets. But that framework, in its standard form, assumes something close to a smooth, continuous path for asset values with well-behaved volatility. Real-world defaults rarely look like that. They tend to happen in sudden jumps rather than gradual drifts. Covenant breaches, credit rating downgrades, sudden liquidity freezes, and defensive reactions from counterparties can all produce enormous multi-standard deviation moves in a single step, rather than the orderly diffusion the options framework assumes. This matters most in what can be described as credit's no man's land. Early in a credit's life, while it is still clearly performing, its price behaves in a roughly straightforward, linear way, and a single spread number is a reasonable shorthand for the compensation a lender is receiving. As a credit deteriorates, its payoff profile becomes far more convex and option-like. Small shifts in the underlying value of the enterprise start to produce outsized swings in what a lender would actually recover, and the outcome becomes highly dependent on timing and liquidity rather than a smooth function of value. The trouble is that market participants often continue treating these deteriorating credits as though they were still simple performing positions, quoting them at a single spread over benchmark rates even though a single number can no longer meaningfully summarize the risk. The more honest approach in that zone is scenario analysis, laying out a distribution of plausible outcomes with explicit assumptions about recovery and timing, and calculating a separate expected return for each one. If that range of outcomes stretches from equity-like gains on the upside to a complete loss of capital on the downside, then what looks like a loan is, in substance, closer to rescue equity wearing a lender's disguise. Anyone unwilling to be compensated on those terms should not be in the position at all. GPU depreciation and the gap between pricing and valuing. The debate over how quickly graphics processing units actually depreciate offers a concrete illustration of Damodaran's broader distinction between pricing an asset and valuing it. By his estimate, adopting a more realistic 2 to 3 year useful life for GPUs, rather than the longer schedules many companies currently use, would add roughly $176 billion of depreciation expense across 2026 through 2028. That is real cost being pushed out of reported earnings even though the underlying cash was already spent. At the level of equity valuation, this matters because price to earnings and enterprise value to EBITDA multiples remain the language most investors default to. At the level of credit, it matters even more directly, because leverage ratios and interest coverage tests embedded in loan agreements are typically calculated off EBITDA rather than off actual free cash flow. Applying standard leverage metrics to a set of borrowers whose EBITDA is inflated by unrealistically slow depreciation schedules will make balance sheets look considerably stronger than they actually are. It is the same pattern seen in prior capital spending booms tied to commodity cycles. Reported earnings look healthy right up until the cycle turns, simply because the accounting has not yet caught up with the underlying decay of the assets. Compounding this, sectors like memory chips and graphics processing units are inherently cyclical, driven at bottom by supply, demand, and capacity decisions that show up in reported earnings only after the fact. For a credit investor, the practical lesson is not to wait for an earnings miss as confirmation. The more reliable approach is to underwrite directly against capital spending plans, utilization trends, pricing behavior, and the pace of technological change, since a business can be deteriorating on all of those dimensions well before it shows up in a still-growing EBITDA figure. The SpaceX precedent and the wider market mood. Damodaran also points to the recent SpaceX funding round, in which a $26 trillion total addressable market figure was used to justify the company's valuation. He describes that number as fiction and argues it matters well beyond SpaceX itself, since similar framing is likely to shape how OpenAI and Anthropic are eventually priced when those companies go public. The broader market mood reflects some of the same unease. Prediction markets tracking the odds of an AI bubble bursting before the end of 2026 have traded around 19%, having spiked toward 30% in May before drifting back down through June, a sign that professional sentiment is watchful without yet being convinced a correction is imminent. Why private credit carries the loss. Pulling the conversation together, Damodaran's central claim is that if the AI build-out does correct, the largest losses will fall on private credit rather than on equity holders. The logic follows directly from how each instrument is structured. If the growth story continues to play out, equity holders capture the full upside while lenders receive nothing more than the coupon they were promised at the outset. If the story breaks instead, equity holders are protected by limited liability and can walk away having lost only what they invested, while lenders remain fully exposed to the shortfall. In the language of options, equity in a distressed company behaves like a call option, while debt behaves like a put, and a passive lender who has not secured real protection is effectively short an option whose ultimate variance is controlled by the equity holder rather than by the lender itself. As Damodaran puts it, a business cannot make interest payments with potential and promise. It can only make them with actual cash flow. His broader worry extends beyond any single borrower to the private credit industry itself. He argues that private credit built its reputation serving a genuine niche, borrowers that traditional banks were unwilling or unable to finance. In his view, that industry has since expanded well beyond that original niche, in much the same way hedge funds and private equity did before it, and is now taking on risk it does not appear to be pricing carefully. The danger, as he frames it, is not confined to the lenders who make the mistake. Because private credit is now woven so extensively into the financing of critical infrastructure, a wave of defaults in this corner of the market would not stay contained to the funds that made the loans. It would create broader social costs and pull other, unrelated parts of the financial system down with it. Private credit is the biggest loser when AI corrects. Speakers: Aswath Damodaran, NYU Stern School of Business, and Joseph Scorn, host. Source: Fixed Plus Floating, the Credit Podcast.